Okay, we can still see people logging in. So we just give this one more minute.
Sounds good.
Okay, I think we can start. So good afternoon. Welcome to the webinar on energy transition in the global and Hong Kong context, organized by the Hong Kong Green Finance Association, Green Bond and Product Innovation Working Group, co-chaired by Oliver Menard from Natixis and Rico Zhang from International Capital Markets Association. My name is Jenny Lee, Undersecretary for the Hong Kong Green Finance Association, and I will be the moderator for this webinar. Before we begin, a few words on housekeeping. This webinar is recorded and broadcasted live on YouTube. And during the webinar, you'll be able to participate by posting a question on the Q&A session. And we encourage you to put your questions there so that the presenters can answer your questions at the allocated time at the end. We have a packed agenda lined up in the next 90 minutes, and I'm delighted to introduce you to our speakers with us today. First, a very warm welcome to Joseph Chan Ho Lim, Undersecretary for Financial Services in the Treasury, the Government of Hong Kong, SAR, who will give the opening remarks, followed by three leading experts who will be presenting on how and what different stakeholders envisage and expect from transition finance. For our first presentation, Chao-Ni Huang, Executive Director, Head of Sustainable Capital Markets, Global Markets Asia Pacific, BNP Paribas, and our very own HKGFA Vice President and Secretary General will be presenting on HKGFA's Navigating Climate Transition Finance report that was published in 2020. The second presentation, we have two speakers from Natixis, Cedric Mer, Head of the Center of Expertise and Innovation, Green and Sustainable Hub, and Thomas Gerard, Head of Green and Sustainable Syndicate. And they will be presenting on transition tightrope and investors' appetite for transition. And the third presentation, Rico Zhang, Senior Director of Asia Pacific International Capital Markets Association, ICMA, and co-chair of Hong Kong Green Bonds and Product Innovation Working Group, will present on ICMA's Climate Transition Finance Handbook. So a very warm welcome to our speakers. Without much further ado, I'd like to pass the floor on to Joseph Chan Ho Lim, Undersecretary for Financial Services and the Treasury, the Government of the Hong Kong SAR, to give the opening remarks. Joseph, the floor is yours.
Thank you, Jenny. Good afternoon, everyone, ladies and gentlemen. It is my great pleasure joining you at today's virtual event on energy transition in the global and Hong Kong context. First of all, I would like to thank the HKGFA for organizing today's event and its continued efforts in promoting green and sustainable finance in Hong Kong. In the face of global challenges from climate change, we see that green and sustainable finance are increasingly finding their rightful place in the world of investment. The global green bond and green loan issuance reached an adjusted amount of $290 billion in 2020, marking a new global record. In fact, the global cumulative green bond and green loan issuance has exceeded $1 trillion, in which over 20% are from the Asia-Pacific region. Nowadays, to the business world, green and sustainable finance is no longer a question of if, but a question of how and where. Hong Kong is Asia's leading international financial center, thus is well positioned to serve the region's green and sustainable financing and investment platform for international issuers and investors. In equities, in 2020, the average daily turnover of Hong Kong stock market and the fund raised through IPO have increased by 49% and 27% respectively, when we also rank number 2 globally and number 1 in Asia in terms of funds raised through IPOs. In the bond market, Hong Kong is the largest center for arranging Asian international bond issuance last year. In private wealth management, Hong Kong ranked number 2 in the world and number 1 in Asia by AUM in 2019, While the 2020 figures are not yet officially published, indicative numbers from major private banks suggest a double-digit growth in 2020 from the already strong base. In the insurance business, Hong Kong ranked number 2 in the world and number 1 in Asia in terms of insurance density. Hong Kong's status as Asia's leading international financial center has well positioned the city to be the green and sustainable finance hub of the region, raising green capital and offering green financial products. Green and sustainable finance is indeed one of the current administration's key policy priorities, and we have rolled out a series of measures to develop green and sustainable finance in Hong Kong. We successfully issued the inaugural and second government green bonds totaling $3.5 billion in May 2019 and February 2021, respectively. The issuances were well received by global investors with multiple types of oversubscriptions. These issuances would provide benchmark pricing for the market and encourage issuers and investors to arrange financing of their green projects through Hong Kong. We plan to issue green bonds regularly and expand the scale of the government green bond program. We will double the borrowing ceiling of the program to 200 billion Hong Kong dollars to allow for further issuance of green bonds totaling 175.5 billion Hong Kong dollars within the 5 years from 2021 to 22, having regard to the market situation. This will also give us more room for piloting the issuance of green bonds that involves more types of currencies, also more project types and more issuance channels, thereby further enriching the green finance ecosystem in Hong Kong. We also plan to issue retail green bonds for the participation of the general public. To elevate Hong Kong's position as a regional green and sustainable finance hub, we will continue to provide the necessary infrastructure and catalysts for promoting market development and encouraging more entities to make use of Hong Kong's capital markets, as well as financial and professional services for green and sustainable investment, financing, and certification. Among others, we have launched a new green and sustainable finance grant scheme in May this year to provide subsidy for eligible bond issuers and loan borrowers to cover the expenses on bond issuance and external review services, with a view to supporting green and sustainable bond issuance and lending to further enrich the ecosystem in Hong Kong. While many policy measures have been launched by the government and the regulators to develop green and sustainable finance over the past few years, in May 2020, we established the Green and Sustainable Finance Cross-Agency Steering Group, with members including government bureaus and various regulators. The steering group aims to coordinate the management of climate and environmental risks to the financial sector and accelerate the growth of green and sustainable finance in Hong Kong. It will provide strategic direction with a focus on regulatory policy and market development, and facilitate regional cooperation, including the Greater Bay Area. Last December, the steering group announced its strategic plan to strengthen Hong Kong's financial ecosystem to support a greener and more sustainable future, demonstrating our strong commitment and determination to boost investment conducive to low-carbon transformation in Hong Kong. Among the near-term action points in this strategic plan, the steering group stated that climate-related disclosure aligned with the Task Force on Climate-Related Financial Disclosures, TCFD, recommendation will be mandatory across relevant sectors no later than 2025. The steering group also stated that we aim to adopt the Common Ground Taxonomy, which will be developed by the International Platform on Sustainable Finance Working Group on Taxonomies, co-led by China and the EU. Over the last few years, we have seen green bonds gaining popularity and traction in Hong Kong. The cumulative amount of green bonds and loans arranged and issued in Hong Kong reached $38 billion by the end of 2020. We have seen local, mainland, and overseas issuers using Hong Kong's platform for green bond issuance. Multilateral agencies such as the World Bank, the European Investment Bank, and the Asian Development Bank have also made use of Hong Kong's platform to issue green bonds, demonstrating the confidence in Hong Kong as the green and sustainable finance hub of the region. In addition to traditional green bonds, we have also seen the world's first real estate sector's green convertible bond, Asia's first green retail certificate of deposit, the world's first Guangdong Hong Kong Macau Greater Bay Area themed green bond, as well as the first offshore EFG Asia ETF issued or listed in Hong Kong. And this week, an asset management company just announced that it is launching the world's first retail offshore renminbi ESG fund here in Hong Kong as well. Speaking of ESG funds, in fact, just yesterday, the Securities and Futures Commission's SFC issued a circular to provide new guidance to management companies of SFC authorized unit trusts and mutual funds on enhanced disclosure for ESG funds. This shall make sustainability-related disclosures more transparent, comparable, and consistent, which will help investors identify suitable ESG funds and reduce opportunities for greenwashing. I noticed that the synopsis of today's event covers how different stakeholders envision and expect from transition finance. Let me take this opportunity to share with you some commercial findings on sustainable finance from a report issued by the Hong Kong Academy of Finance last year. For issuers, green bonds reduce a firm's cost of borrowing. The cost advantage is prominent by close to 50 basis points when the green bond is verified or certified by an external party. Issuers of green bonds also benefit from the equity market performance as well. On the issuance of green bonds, the share price of the firm typically reacts with an upward jump when the green bond has received independent verification or certification, reflecting the importance of transparency and corporate governance. There is also accumulating evidence suggesting that ESG investments, including green bonds, may outperform the non-ESG counterparts and better weather adverse situations. For instance, during the COVID-19 pandemic, green bonds have been found to provide a better risk-return trade-off when compared to conventional bonds. Ladies and gentlemen, climate change is one of the major risks threatening the well-being of mankind. It must be tackled on a global basis across different sectors of the economy. In the policy address announced last year, the chief executive stated that the Hong Kong SAR will strive to achieve carbon neutrality before 2050. The chief executive also stated that we would develop green finance to boost investments conducive to reducing carbon emissions, build a low-carbon economy which is more resilient to climate change, and enhance public education and publicity. We and our regulators will continue to work closely with you, the industry stakeholders, to leverage our role as a leading international financial center to mobilize capital towards sustainable projects in the region and enhance Hong Kong's position as the green and sustainable finance hub of Asia. On this note, I wish you all a fruitful event today and a future blessed with thriving and sustainable businesses. Thank you.
Thank you, Joseph, for the opening remarks. It's exciting to hear that the initiatives, infrastructure, and cross-collaboration that is taking place across government, exchange, private and public sector, and industry bodies is really thriving in Hong Kong. And next, we will have Chao Ni, who will present on HKGFA's report on navigating climate transition finance, which was published in 2020. That really, again, aims to provide a framework to help market authorities and participants define an operational structure for climate transition finance in Hong Kong, mainland China, and beyond. Chao Ni, the floor is yours.
Thank you very much, Jenny. Good afternoon, everyone. Welcome, Hong Kong JFA members back to our platform to explore climate transition. And many thanks to Joseph, Undersecretary of STB, for coming back to Hong Kong JFA as well, who is our regular and keen supporter for green finance. So I think many of you have heard about the scale of transformation of our economies and the urgency for such a transformation from Joseph's opening remark, if we are to achieve the goals of Paris Agreement. So in response to immense financing needs of this transformation, green and climate finance concepts were created and has been in strong momentum to facilitate capital allocation towards these activities. And this contribution typically involves enabling mitigation activities, such as reduction of GHG through renewable energy adaptation, as well as adaptation initiatives that protect us from damaging impacts of warming climate, sea level rise, and extreme weather events. And with China and Hong Kong SAR have committed their net zero by 2060 and 2050 respectively, while the current green and climate finance tools are critical in allocating capital towards this transformation, we will likely need more tools or new tools going forward. So in particular, industries that are historically high emitting or face the constraint to decarbonize might not have access to the existing green finance pool to accelerate their transformation or transition. So if you think about steel and cement, right, these are important sectors to our economy and continue to be fundamental to our economy. So they have, relatively high, they are very high emitting today, but, they still have a key contribution to make in the fight against climate change. So in order to capture these financing needs, a newish climate finance label is emerging to encompass sectors and activities that might not be able to become entirely green today, but where partially satisfactory improvements will be instrumental for a net zero world. So the clarification on the definition of climate transition finance will facilitate purposeful capital allocation towards these kind of needs. So our paper, which was launched last year in our annual forum, really proposed a principle-based framework to define climate transition finance in the context of market development in China and Hong Kong SAR. But we also think it has the potential to be relevant, for Asia as a whole, as well as other areas, markets, globally. Next slide, please. So when we, put together, the principle-based framework, we want to recognize the existing market acceptable frameworks that can be applicable for climate transition finance. Firstly, we recommend actually adopting the format and transparency requirements of existing regulatory standards or market acceptable frameworks such as, the ICMA principles, Loan Market Association principles, as well as, China green standards and EU green bond standards, so on and so forth. And these common requirements, across various jurisdictions are very much in terms of defining use or proceed, defining the process for project evaluation, selection, cash management of proceed, and ongoing disclosure, and also using independent external review to give that validation, right? But on top of this, next slide, please. We also propose a 5-step approach or framework for much needed contextualization to provide that critical information to enhance a credible transition story or trajectory, of the borrower or the issuer. For example, first step would be explain the company's mid to long-term plan to align with Paris Agreement, and their plan might include, for example, capex shift, revenue shift, and as well as evidence that these shifts are in motion, right? So China's new real economy borrowers would have to set at least the same reduction targets as China's 2016 NDC or higher, given China's new pledge to be carbon neutral by 2060. And secondly, is for companies, issuers or borrowers, to really explain their constraints that they face when engaging in low carbon activities, right? So these kind of constraints can be due to geography, sector, technological, reasons, and provide the evidence to back them up. So actors should be transparent, in explaining what, why, and how these constraints prevent them from adopting low carbon activities. For example, they can provide financial models with assumptions and resources cited to add credibility to the real constraint that they face for transition and transformation. And thirdly is to elaborate on partially satisfactory technologies and activities that are considered eligible or viable for climate transition financing. So example of useful information include emission reduction targets expected against decarbonization trajectory, and credibility of technology and activity in the context of the countries or markets that they operate. Fourthly is explain the measures in place to ensure, such operations, activity, or investment do not deliver any significant harms, right, for non-climate related sustainability objectives. So again, this is quite similar to what you see in the EU taxonomy, where do no significant harm principles are in place to make sure you are not violating other environmental objectives while achieving climate outcome. So this is where issuers need to talk about local environmental and regulatory approval can be as the baseline, and further contextualization is also encouraged. And finally is to explain a deliberate phase-out plan for these partially satisfactory technologies, right? Because we were talking about interim transition pathway, but the ultimate goal is still for us to achieve net zero. So it's very important for issuers and borrowers to talk about, the phase out, by the point you reach an interim, target, how do you really go about towards net zero, so that we don't get into a situation where carbon locking is created. So this is really about replace, partially satisfactory technologies and setting aside a decommissioning fund, for example, for replacement, using local and regional decarbonization trajectory as important references. So we think this 5-step approach will be very important for issuers, borrowers to consider transition finance in their funding. To support, to fund sustainable transition activities and assets and projects in the interim for the hard-to-abate sectors. So we hope these will provide guidance to market authorities as well as market participants to adopt, so that we have some transparency and consistency in defining transition finance. So what are the implications for market players? Next slide. In the interest of time, maybe I would just pick the two largest group of market players, banks and asset managers. So for banks, banks certainly have a huge role to play to influence transition financing very directly through their own lending policies, as well as through their advisory business, right? So as transition activities could over time be considered brown actually in nature, it's important for banks to evaluate the relevance and appropriateness of their existing CSR lending policies. And furthermore, very often, non-brown activities, those that pass the CSR screening, still do not qualify green or even transition. As such, the CSR lending policies actually play an important role, but relatively passive in fostering an economy aligned with the low carbon future. So the ideal scenario would be for CSR lending policies to actively restrict financing, not to sector and activity that are not aligned with the sustainable future. But regulatory support would be needed to create a level playing field and fair environment to enable the adoption of this kind of approach. And when banks serve as a structuring advisor in transition finance transactions, it's important to provide issuers and borrowers with professional and impartial advice to uphold the integrity of green credential in a transition finance label or deal. So I think it's still very important that there's, even though we are talking about partially satisfactory technology, you know, in a potential transition bond or transition loan, there's no zero tolerance, you know, when it comes to greenwashing. For institutional investors, you know, we think it's a natural fit, you know, for the ESG investors in Asia as well as globally to consider transition finance, transition bond as part of their asset allocation, as long as there's adequate risk-adjusted return on capital and the contribution to transition is credible. Again, investors, you know, could also use the framework that we propose as a way to assess how credible the transition bond, the transition story of a particular issuer or borrower. So in terms of outlook, next page. You know, it's estimated that the new climate economy would need trillions worth of dollars in the next 10 to 15 years to be invested in new infrastructure before 2030, more than the current stock. Sorry. And the sustainability of this infrastructure will be critical determinant of future growth and prosperity. So, and if you put into the context of Belt and Road, where we are talking about even multi-trillion-dollar worth of investment in across 60+ countries from Asia, Africa to Europe, all these new investments should ideally be green or at least transition related. So these kind of large-scale transformation change are very necessary, and we really see the role of transition finance and broadly green finance will be extremely important for us to achieve, you know, that kind of decarbonization. And zooming in China, right, specifically, there are clear needs for transition financing with the growing momentum for ESG integration. So, you know, even though China has achieved, you know, some remarkable carbon reduction, there's still a long way to go as one of the largest carbon emitters in the world, and also second highest carbon emission intensity for its industry. So we think climate transition finance will be critical to help China to transit towards a low carbon economy, particularly towards net zero by 2060. So this concludes my presentation. I hope it really gives you a picture of what we think transition finance should look like, at least in the in China and Hong Kong context. And very quickly, I really want to thank members of the Hong Kong GFA Green Bond Working Group to put their heads and hands together to make this report possible, as well as under contributors, which I don't have the time to thank. But over back to you, Jenny.
Thank you, Channing. That was an excellent overview. For those online, if you'd like to read the full report, you can actually find this on the HKGFA website. And I think the report really highlights the demand and need for transition finance, and also the alignment of taxonomies, transparencies, and implications for all stakeholders, which I think Joseph had also alluded to during the opening remarks. And this really sets the scene for the next presentation, Transition Tightrope and Investors' Appetite for Transition, which unpacks the demand, risks, and opportunities in transitioning brown industries and investors' demand for transition finance. And this will be presented by Cedric and Thomas from Natixis. Cedric and Thomas, the floor is yours.
Thank you. Thank you so much. Do you see and do you hear me?
Yes, we hear you.
Okay, perfect. Can you switch to next slides, please? So I'm going to present you what we call the transition tightrope, and hopefully the guidance and insight we will share with you will show the pathway to walk that tightrope. So as explained by Shani, engaging high emitting industries in sustainable finance is of the utmost importance, especially the heavy industries. They are for some of them irreplaceable and providing our economy some basic materials. So the what is very clear. The why, there are various drivers requiring brand industries, brand companies to transition. Of course, they revolve around reputational risk, talent attraction and retention for some companies. There are, of course, a personal and market risk for avoiding being squeezed with market expectations, but also grow in new segments. So there are business opportunities. And last but not least, there are regulatory and financial risks that are entangled. From a funding standpoint for companies, you may face some divestment. There will be capital requirement adjustments across the world, meaning capital will be more expensive to finance brown industries, and there are ESG mainstreaming across the investment industry spectrum. From the regulatory standpoint, and there are clearly a trigger of financial risk. Of course, carbon pricing is one of them. Banks are undergoing climate stress testing, and there are also some political risk, meaning that companies that are lagging behind too much in terms of decarbonizations, they could face pressures and political measures from governments. So that's the why, but the most tricky part is the how. So at Natixis, we've tried to put together a very simple methodologies that map levers, actions that can be undertaken by brown industries. So we have put together 5 levers. One of them is to exit, to quit the activities that are the most harmful to climate change. To name a few, coal or tar sand, for instance. Another lever is to decarbonize your core and hard-to-abate activities. So by switching feedstock, by investing in energy efficiency, so you continue to produce the same services and products, but you deep decarbonize them. Another lever is to diversify your activities and your product mixes. For instance, for an oil and gas company, you are going to penetrate the renewable energy segment. And once you have done all of that, you are going to offset your remaining greenhouse gas emissions. And there are 2 main options, one being carbon capture and storage, the other being reforestation through forestry. So these are the 4 levers to transition your own companies, but you can also position to help other sectors and companies by providing decarbonization solutions. And let's mention just one example. For instance, if you produce biofuels, you will help the aviation sectors to achieve its own transitions. So that's the big pictures. If you can switch slide, please. So as said before, we really need to embark brown industries, and as of today, our economies are predominantly brown, and we are heading towards probably 2.5 or even above 3 degrees temperature increase. So there is a tightrope because we cannot remain in a niche. Meaning focusing only on pure green activities, but in the same time, we cannot accommodate minor improvements. Even for brown industries, we need a transition at the proper scale and at the proper speed. So that's a kind of tightrope to be walked. And we do believe that the topic of transition must be assessed at entity level. So it's not simply a matter of assets or projects, but you really need to look at the entity and the way it is transforming its activities. So that's why the general corporate purpose instruments with KPI linked features are in our view, very instrumental to steer to finance the transition of brand industries. But clearly there is a need for guidelines, for safeguards and tools to avoid transition washing. So next slide, please. So as I said before, brown industries are really the elephant in the climate in the climate war room. So on our website, so there is a dedicated page on Transition Tightrope. You can find out all the chapters, the interviews, the investor survey we made. So I invite you to have a look. Next slide, please. So we are talking a lot about transition, but what's the meaning? So in our view, transition is a period. It's an interim period for a company during which it transforms its business model and activities to adapt to a new paradigm. In our case, that's a carbon constrained world. So it means that transition is about pathway, and it's a forward-looking and holistic concept, and that having that definition is very important because accordingly we'll suggest some product structuring guidance. So next slide, please. Yes, transition is about entities and the consistency of their actions. It's a process. It's a pathway. So you really need to provide some intermediary targets and explain how you are going to transition. It's about your performance, your willingness, but also your disclosures and the dialogue that you can have with your banks and with your investors. And the concept of accountability is of the utmost importance. Really to engage and to have a constructive dialogue about the initiatives that are being put in place. Apart from performances, efforts are very important because not all the companies are yet where they should be. So how you do in terms of R&D, in terms of CapEx, but also the governance and incentive that you are putting in the company are very important. So next slide, please. So that's a bit of wrap up of what we cover in our report. So it's not an option; it's a matter of when. Clearly, regulatory responses are piling up, so it's a bit hard for companies to cope with all these requirements, especially in Asia, in Europe, and even now in the US. Things are changing fast. When you talk about transition, you need to provide a comprehensive view about the timing and order. That's very important to show that you have a strategy, a time-phased strategies. And as said before, stranded asset and liability risk are increasing. So we can switch slide. So and the next one. So we try to unpack the transition box. So a bit of disclaimer. We need to be cautious because when we talk about transition, there are risks, especially of carbon locking, meaning you invest in assets in companies that are locking CO2 in the economy, and there are also a risk of rebound effect. So meaning that you will reduce the intensity, but the absolute emissions will increase. So that's very important, and we should avoid transition washing. That's very important. All that being said, there is a big topic when we're talking about the transition. It's the notion of fair transition and the consequences that the workers of these high emitting sectors are going to face, because we cannot afford from a social and political standpoint to have 100,000 people fired and losing jobs. So we really need to care about the people in these sectors and to provide them schemes, new jobs, new opportunities, because if we don't, it will be an obstacle in our endeavor to a low carbon economy. We are talking about brand companies, but there are a few differences between what we can call replaceable activities and irreplaceable ones. And depending on where do they stand, and we need to provide criteria to categorize them, they will have to do more efforts. Some of them will have to shut down some of their activities, or they are to shrink, or they are to transform. So we have tried to put together, and you can see it on the next slide, very simple criteria about the classification of brand industries. So there are questions about the existence of alternative technologies. Do you have substitutes at scale and that are affordable? But there are also social criteria. Are you providing services that are accessible to a large segment of the population, or only a few? So that's very important because, as said before, not all the sectors are equal. And if you go to the next slide, we have tried to map a number of them. It ranges from cement, steel, mining, agricultures that are very what we can say irreplaceable, and there are others such as coal mining, plastic packaging, or cattle farming that are more replaceable because we do have substitutes. And that the same, for instance, for transport, it's easier to electrify passengers vehicles, while by contrast for road transport and for heavy trucks, it's much more challenging. So these are a bit of criteria that you can include and that you can that can feed your transition strategy and analysis. So next slide, please. As said before, fair transition is a very crucial topic. There will be plenty of new jobs in green sectors, but also a number of ones that are going to be shattered, that are going to be destroyed. The problem is that the workers from the high-emitting industries are not always the one getting the new job. So there will be massive reallocation of job destruction and creation around the world. What is interesting, the ILO, the International Labour Organization, is pinpointing that most of the job will be created in Asia and Pacific. So that's very important. But for sure, you need a bit of forward-looking engagement with local governments, with unions to really have a proper steering and strategic planning of the social consequences of the transition. So next slide, please. So we have proposed transition levers and case studies across a number of companies. So you can go to the next slide. These are the levers presented before, the five levers, and you also need to look at the governance, the investments, and the timeline involved in the transition pathway. On the next slide, you have a mapping of different companies. So Ørsted, Drax, Inson, Neste, Vestas, Rio Tinto. So we have mapped the way they activate levers, and it's really a framework to analyze the company. And it could be useful to design transition financing solutions to classify and to make the strategy more understandable for the investors. So on the next slide, you have a few case studies that are in the report. Some are a bit in depth. There is one on Etihad Airways, for instance, another on Lafarge-Holcim, or Maersk, the freight company. So I invite you, if you're curious, to have a look. On the next slide, so once we have put all of that together from a transition standpoint, let's talk about instruments. So on the next slide, so what we can say is that brown industries are still predominantly absent of the market. There is high appetite from investors. My colleague Thomas will further elaborate on that. We have new standards, and we have developed guidance, especially through the ICMA sustainability bond principles. We have been drafting these principles, and we have seen a number of brown companies using this format, which is very relevant and very suitable to them. So I am I think I am done on that. I will give the floor to my colleagues, Thomas Gérard.
Okay, so hello everyone. Can you hear me well?
Yes.
Okay. Can you maybe go on slide 36? Okay, thank you. So I'm going to try to enlighten you on what's happening on the investor front, I will say, and especially with regards asset owners, starting with insurance companies and also asset managers. What are they doing on transition? Next slide, please. So maybe first I wanted to make an update on the EU Sustainable Finance Regulation, the ESG markets, social responsible investment historically has been pushed by the demand, but now we have a great support from various regulators globally, and Europe, which has historically been the most active area when it comes to socially responsible investment, has the chance to be supported by the European Commission and the European Sustainable Finance Regulation. The EU Sustainable Finance Regulation is backing the European Green Deal, and the first taxonomy, which was released by the European Commission this year, is on climate change mitigation and adaptation. There will be other taxonomy for sustainable activities, but as a starting point, we are all focusing on climate change and the transition to a low carbon and more resilient economy. So I will not go into too much detail with this slide, conscious of time, but there is a various set of regulation which have as a bedrock the EU taxonomy. Some of them are directly impacting the financial sectors. The financial sector, like standards and labels, but also, and I would say, especially today, the Sustainable Finance Disclosure Regulation, which is about enhancing transparency to end investors, institutional investors, but also the retail individual investors, how market participants are considering sustainability at entity, but also at product level. And now, because this regulation came into force and is meant to be applied by portfolio managers and portfolio management companies, they have to classify their product, their funds, into various categories, notably in two of them. They need to make clear if they are paying attention to ESG, and even better, trying to deliver environmental and social benefits. There is also a regulation on benchmark, regulation, generally speaking, on all companies, all economic players with the corporate sustainability reporting directive. So keep in mind that regulation is definitely a key lever for transitioning, and as an example, the EU and the European Commission is definitely supporting that. Next slide, please. So on this slide, you will see the roadmap of this sustainable finance regulation. As I mentioned, we have now, since April 2021, the EU taxonomy on climate change mitigation and adaptation. There will be others, as I mentioned, and as you can see on the right left side of the slide, taxonomy on pollution prevention, circular economy, biodiversity, and so on. There is also, and I think that it's worth to note, I would say recommendation coming from regulators and the European Banking Association, but also the regulator for the insurance industry or for the financial markets. They are all reacting and making recommendation to the European Commission in order to make climate change as an important issue for the future climate stress test they will conduct. So for the time being, there is no official or mandatory climate stress test in Europe, but there is here and there some trial run with voluntary companies, credit institutions that are factoring and stress testing their portfolio in order to see where climate change can have an impact, and how to cope with the various risks which have been quoted by Shaoni and Cedric before, that are linked with the climate change, regulatory, but also physical and transition risk. Next slide, please. So insurance companies on transition, what is happening? I will say, generally speaking, first, we have a map and trying to to assess what are the ESG megatrends that are impacting the insurance sector. Definitely, climate change and transition to a low-carbon economy is on the top of the agenda of insurance companies globally. As you can see, we are actually thinking that there is three major risks or three major trends, because you can see it as from a risk perspective, but also from an opportunity one. First is on climate change, adaptation and mitigation. Secondly, it will be on natural resources, everything related with biodiversity, I would say. And then social cohesion. And these mega trends are having an increased impact on the sector. Next slide, please. We have reviewed 38 insurers, global insurers on ESG. So as a starting point, I would say that, and you all know that, ESG is now in the mainstream, and so we see ESG practices and a good level of maturity from most of the insurers that we've been reviewing. The level of maturity depends on the insurer, and it's also very linked. This is why I wanted to update you on what's happening in Europe, but it's definitely relying on the regulation and the push or the incentive from regulators to support ESG integration in insurers, but also in banks and in investors' business activities. And notably amongst the three ESG pillars, climate change and transition is definitely key, because we can see climate change separately from ESG approach as a systemic risk. A growing number of insurance companies are also making publicly available oil and gas policies. I would say, more generally speaking, they are positioning themselves on fossil fuel. It started around, I would say, the Paris Agreement with the coal campaign, and a lot of insurance companies globally have decided not to underwrite anymore or to invest in companies or in the coal sector. And now this is progressively impacting other fossil activities, starting with Arctic drilling, offshore drilling, every unconventional petroleum such as tar sand. So I would not say that insurance companies are exiting the fossil fuel sector, but progressively they will select more carefully the project, the companies, the investment they made in fossil in order to be in a position to reduce the CO2 emission of their portfolio. A growing number of insurance companies are also adhering to alliance or initiative, net zero initiative, as you can see on one of the column. There is actually today various initiative, the Net Zero Asset Owner Alliance. There is also the Net Zero Asset Management Alliance, Net Zero Banking Alliance, and Net Zero Insurance Alliance, which is about to be launched at Glasgow COP26. So in this slide, and just to give you more detail on the analysis that we've been conducting on insurers, not to benchmark them, but maybe more to see where are they on their journey to transition. So you see market standards on the one hand and best practices on the other. Amongst the market standard, you have sector policies. We can see also an insurance company signatory of the UNEP-FI principle for sustainable insurance as a good proxy to assess the level of willingness of a company to integrate ESG and to transition. PRI signatory on another with regard to investment, complying with increasing regulatory pressure, notably with the DCFT, but also with the local standard. There is also the support to UN SDGs with regard their offering of insurance product and policies. There is also a sustainable insurance target that we see in the landscape. And when it comes to best practices, so I mentioned oil and gas policies. There is also green investment targets. Some insurance companies are declaring that they want to invest XYZ million or billion euro or USD in green assets. There is also a 2-degree alignment methodology echoing the signatory of initiative of the Net Zero Asset Owner Alliance, for instance. Well, this is just examples, but proxy in order to capture the level of maturity of insurance companies on transition. Next slide, please. I will not go into detail. You will see in this slide afterwards. You will have the material, but the various announcements from European and Japanese companies, insurance companies as well. I'm gonna jump on the next one, conscious of time. So asset manager, briefly. Next slide, please. So, as I mentioned, ESG goes to mainstream. So ESG now is incorporated in listed assets. The focus is now on alternative and real assets. So in private debt, I would say. And we see green investment strategies which are launched. It started with equity, now it's on bonds in order to support this transition. So we see quite a number of green bond funds, as you will see in the next slide. So you will see on this slide, various information on asset managers when it comes to ESG and transition. On this slide, this is a synthesis of the various investment strategies that can be used in order to transition. So you have negative screening on the one hand, ESG integration, which often end up with best-in-class selection, investor engagement. And when it comes to investing in product, you have a two-leg approach, the use of proceeds with green bonds or transition bond with earmark proceeds, and KPI-linked bonds, sustainability-linked bonds, already mentioned by Cedric. Next slide. In terms of market dynamics, and especially when it comes to sustainable bonds and I would say green bonds in our case. So Europe is still the most mature market, and in North America you have very active players, but only a few. This was linked to the impetus of Donald Trump with regard to climate change, but things are changing with the new US administration. When it comes to APAC, we can say that investors' appetite is still in its infancy, with an exception in Japan, with the Japanese lifers, which have historically appetite for ESG and which are supporting the achievement of sustainable development goals in their investment. There is also, and this was mentioned at the very beginning of the webinar, but there is also a dynamic emerging in China, and we have seen the launch of several, but few green bond funds, notably from Ping-Han of China Asset Management. And in Australia, there is also some players, such as Artesian Capital Management, which are launching investment strategies to support the achievement of the UN SDGs and the transition to a low carbon economy. Next slide, please. So on this slide, here is a list of, I would say, the most active investors globally when it comes to investing in green bonds and in supporting the transition. You will see on this slide what we can consider as a flagship product, flagship strategies. Some of them are focusing on emerging markets. There is some partnership between the IFC, for instance, and Amundi, but also with the HSBC on asset management, both. When it comes to investing in emerging countries and in financial institutions or non-financial corporates supporting the achievement of the SDGs and the transition to a low carbon economy. And just as an example, again, Amundi launched in December a Just Transition Fund, again echoing with what have been mentioned by Cédric. It's not about a pure transition of players when it comes to energy, but also we need to pay attention to the impact on social. Hello? Can you hear me now?
Yes, yes, we can.
Okay, no, it was my colleagues who were warning me that they can hear me. Anyway, next slide, but I'm thinking I'm done. Yes, I'm done. So yes, just as a conclusion, so we see globally definitely a lot of investors, asset owners and asset managers skinning in the game and wanted to support this transition with the flagship product and strategies, but generally speaking with the targets to invest in green assets or in transition assets, considering that we are not living in a green world, at least to date. I'm done. Thank you.
Thank you so much, Cédric and Thomas. I mean, I think you really put a wrapper around the energy transition from a global and then into like the Hong Kong context. So now we've heard from our speakers on the importance of contextualization to build a credible transition story. And we've talked about the levers, I guess, to transition brown industries and the rapidly changing regulatory landscape and challenges for investors as they define the low carbon investment strategies and their pathways to net zero. Our next speaker, Rico Zhang, will present on ICMA's Climate Transition Finance Handbook, a reference for issuers to consider when raising funds for debt capital markets, covering the types of disclosures required to implement a transparent and science-based strategy necessary to facilitate the capital flow. Rico, the floor is yours.
Thank you very much, Jenny, for the kind introduction. And I'm very happy to present the Climate Transition Finance Handbook, which we published last December. You'll probably be aware of quite a few transition bonds issued in the market already. And you probably also know that the GBP AGM was held just a couple of weeks ago, and we updated the whole set of standards, different standards, principles, and even the GBP, the Green Bond Principles, which the last version actually is back to 3 years ago. So a lot of development in the market. Before I go through the Transition Handbook, I want to set the scene that to show you the family tree of the products and also the standards we have released for the market to use. So from the slide, you can basically see 4 products, which are the mainstream products for the debt capital market. Either use or proceed, we call the UOP bond, which are green, social, and sustainability bonds, or the not specific to target to the use of a proceeds. It's more like a general purpose for the issuer level. It's the sustainability linked bond, which was released last June. So far, we have the 2 sets of different products, the 4 products available. They are more financial instrument guidance to really guide the market when they tap the debt capital market. while transition handbook actually, or the transition labeling, is not a product. I want to emphasize that actually there are no transition bond principles, simply because now market are pretty much satisfied with the current approach with either UOP bonds or the SLBs. So the transition labeling is rather a thematic guidance for the issuers to really change their company strategy to commit such climate transition. And when they tap the debt capital market, they still first follow the relevant principles and the guidelines to tap the debt capital market. But if they really have such a transition strategy, they can also use such transition labeling to when they issue such debt. Next slide, please. So we have 4 elements really recommended within the handbook to give the guidance to the issuers. There you should have the right climate change strategy. Such a strategy should really material to your business model, and also that should reference to science-based targets and pathways. And also you need to have a very transparent disclosure to really basically to tell the investor where the money is going to. So this actually gives extra disclosure for the issuers to the investors when they tap the capital market, how their transition strategy could be, and basically disclose such to the investor communities. This actually is very encouraging, especially to the hard to abate sectors, because the high emitting sectors, as you know, they are really hesitant to tap the capital market for the green bond or social bond. They are maybe think they are not qualified enough to issue green bonds, but for the whole economy to really transition to net zero, those high emitting sectors are absolutely should be part of the journey and within the community. So these now actually can labor transition when they tap the debt capital market and prove they actually commit to such a transition strategy. I personally believe that now with all the different standards, people talk about ESG all the time, probably taxonomy is one of the priorities for a lot of jurisdictions and the regulators to consider. But actually transition to some extent is more important because simply because the high emitting sectors actually, they are the key to really for the economy, the real economy, to change sustainably. So again, the handbook actually is just to give such guidance, very high level guidance to the market, how to do that. But again, I want to basically just to say, just with other principles we have released, such handbook actually is voluntary guidelines. So any issuers are not obligated to use that, but actually for extra labeling of transitions, that gives some really good comfort and a really good reference to the investors to tell them where the money, their money will be invested into. And obviously, it will be a good reference to a lot of official sectors, to different jurisdictions, particularly in Asia. Next slide. So for the 4 elements, first is the issuers need to have a very clear climate transition strategy and also a framework to govern how it will implement such things. Second is definitely it should be a very material to its business model, and it will bring significant change to its business pattern to really align with targets of the Paris Agreement. Then third, such strategy should be science-based and to really have a pathway and a trajectory to do that. And we don't define actually such science-based targets, we will leave the market to do so. Then the last is obviously the disclosure. You need to be very transparent about such implementation. Next. So first is the strategy. This is really about communicating about your strategy to the investors, whether they are aligned with any recommendations, for example, TCFD or other frameworks. Again, at the SMA level, we don't define such frameworks simply because sector by sectors, it's always very hard, and also jurisdiction by jurisdiction, it's basically impossible to set such standards globally. But again, you need to have such a strategy and a governance to make sure that such a strategy is well implemented. Next. Also, the maturity to your business model also is very, very important, because that will actually reflect the issue's commitment really to such transition at a Paris Agreement. We don't want to be set really minor KPIs or other maybe not that important factors to the issuer's business. It should be very, very strict, and such financing should have a very material impact to its business. Next. Design-based pathway and targets would be a good reference and credible for the investors to actually to look at such instruments issued in the market. So for such transition strategy, they always should reference back to such science-based targets. There are a few standards and methodologies outside in the market. Also, some national standards or different frameworks. We very much recommend such issues to look at closely and to see any most relevant standards they can reference to. Next. Last but not least, transparency is always on the table for the investor to emphasize. Any issuers, have such a strategy, they always should have such implementation plans and how to make sure such disclosure can evidence a credible transition strategy. Investor would very much have a high expectation for the issues to do so, and also independent review would be necessary for such disclosure to have credibility in the market. So that's pretty much what I want to present, relatively short compared to the previous ones. I think with the market color and also the standards in place, I think we set a very good context for the discussion right after this. This webinar is rather a two-way discussion of really for all the market participants to engage with the right stakeholders and to provide such solutions for the market, particularly for the next step in Asia and Hong Kong. I pass over back to Jenny.
Great. Thank you, Rico. That was extremely comprehensive and concise. And I think it really reiterated the importance for issuers in terms of disclosure, transparency, taxonomy, everything that's been highlighted by our speakers today. We now open the floor up to Q&A. I see we have a few questions already that has come through. We have 10 minutes, so I will go through a couple of these questions, and hopefully we can get through as many of these in this very short time frame. So I guess we have the first question really is posed to yourself, Rico, in terms of what can capital markets, including issuers, banks, investors, regulators, do to further accelerate transition?
Well, that's a hard one, but obviously the transition is complicated. I think even for Hong Kong market, we have different issues from different jurisdictions. So again, basically, at least we can give some high-level recommendation if they want to do this. But I think relatively important is the capital market should open-minded to have different sectors issuers to allow them to tap the debt capital market when they use different financing instruments. So as I said, different issues probably, again, I only can comment from a debt capital market perspective. I think different issues have at a different stage along with the journey of the transition. So they obviously have different experience and also how to transition themselves to Paris Agreement goals. So we have the right instruments for them to get into, and also it's important to set a strategy at the company level to really make the transition works.
Great, thank you. We have a question that looks like it's directed to Channing. For the 5-step credit transition story as mentioned, Channing, what targets, dates, which year should we aim for as a hard deadline? I think this is really referencing the fact that you've got the 2030, the 2050, 2060, and so some kind of like perspective there would be helpful. Thank you.
Absolutely, that's a really good question. Unfortunately, I don't have a straightforward answer because in terms of a hard deadline, it really depends. But I think we can really use the Paris Agreement as the ultimate reference, right, for the ultimate deadline. So 2050 net zero. But make no mistake, 2050 net zero is an global average. So some country will reach that earlier and some country will reach that later. So I think when we think about if you are an investor, or even if you're an issuer, if you think about setting an ultimate deadline for yourself to achieve net zero, is to also contextualize it back to your regional country level decarbonization pathway. So I think at the very minimum, you need to be in line with the country jurisdiction decarbonization pathway. Certainly, there's always aspiration for certain entities to achieve that earlier, if possible. So I think the constraint will again go back to what kind of sector we're talking about, what are the current viable technologies that allow you to achieve that, and then what's the real transformation kicks in, where you will phase out the transition technologies and activities. So if you, for example, right, if you think about natural gas, certainly there's a lot of development in emerging Asia, for instance, to replace thermal coal with natural gas as their transition pathway. Natural gas, I think there's certainly, it's debatable in terms of its carbon potential, but if you look at the short-term or interim environmental impact, it is half of the emission of thermal coal, right? So it does play a role in contributing to climate benefits. But we are not saying you should be complacent with natural gas itself, because according to EIA, natural gas, should be phased out by 2040. And if we continue to deploy or use natural gas as the energy source, then carbon capture, storage, utility, has to be part of that whole package to make it compatible to Paris Agreement. So it's very sector specific, jurisdiction specific, but I think ultimately the Paris Agreement is what we all want to achieve. Thanks.
Great. And I think we now have another question in relation to, could be related to Natixis, like how does the EU taxonomy impact transitioning for investors in Asia Pacific? I think that's bringing the global back out to Asia. So Cedric or Thomas?
Yes,
Absolutely.
I can start. Do you want to start, Thomas? So at this stage, what we can see is that there are competing taxonomies worldwide, or maybe not competing, but different classifications. We do consider that what the EU is doing with Chinese authorities to compare the taxonomy, to have some common ground, is very welcome and much expected investors. So we can say that they are in a wait and see attitude, asking us what are the main differences, how can I meet the two set of clarification requirements. So there is a need for clarification. When it comes to the EU one, there are some extraterritorial consequences indeed, especially, for instance, for European companies that have activities in Asia, in China, and if they want these activities to be counted as taxonomy aligned. So there is work to be done there. So at the moment, I would say high expectations, lucidity on the two different systems, and looking forward to comparability tables and more guidance from both authorities, EU one and Chinese one.
And I may add something.
Maybe Thomas, you want to?
Yeah, I think that first we need to stress that the dedicated act of the climate taxonomy has just been published, and it will take time to be implemented indirectly by investors with regard to their investments. But going forward, they will definitely invest progressively only in bonds, in companies that are applying the taxonomy and which are compliant with it. But it will take time. And then I think it's definitely, as Cedric mentioned, it's maybe more the other way around. The taxonomy is more impactful, at least today, to companies out of Europe that are issuing green bonds. Investors in Europe will need to invest in bonds that are aligned with the EU taxonomy and the EU green bond standard. So the impact will be maybe more in this sense, rather than having a direct impact on APAC investors.
That's great, thank you. And I think the overall cover, looking at the China and the EU taxonomies and how they'll consolidate for Hong Kong and how they'll be used, I think will be interesting to watch. I think we have a question now for Joseph Chan Ho Lim. And this is really a question in relation to Hong Kong itself. What are the prospects for establishing a green bank in Hong Kong?
Thank you, Jenny. Well, I suppose when people talk about green bank, right, we are referring to whether we should set up a public or quasi-public financial institutions in order to attract or mobilize private capital into green or innovative projects. But apart from just using or setting up a green bank, actually there are other means of achieving these objectives. And in fact, there are multiple channels that are already in motion at the moment. So if you look at Asia, right, in terms of the multilateral development bank, such as ADB or AIIB, they have been already mobilizing private capital for green investment. And of course, in fact, let's say ADB has also used Hong Kong to issue green bonds already. In terms of the government, what we have done in Hong Kong, as I mentioned earlier on, is that we have established the government green bond program, where we use the proceeds from the government green bond to finance green public projects. So in that sense, it also help lead by example, provide benchmark pricing, and also help mobilize other issuers and investors to use Hong Kong for the green financing activities. Talking about banks, I also want to highlight the fact that in Hong Kong, we have a strategy to promote green and sustainable banking. In fact, we are adopting a three-phased approach to do that. In phase one, we develop a common framework to assess the greenness baseline for individual banks in Hong Kong. And then on phase two, through consultation and engagement with the industry, we are setting tangible deliverables for promoting green and sustainable development of the Hong Kong banking industry. And then on phase 3, with the target already set on phase 2, then we will implement and monitor and evaluate the bank's progress of on these targets, so that we have a strategy on the green and sustainable banking on that front. But as I mentioned early on, in terms of mobilizing private capital into green and sustainable finance is definitely the global trend. And I think in Asia and Hong Kong, using the multilateral agencies like ADB or AIB, or using the government green bond program here locally, are achieving these purposes. Thank you.
That's great. Thank you so much for that clarification. I think there's also another question that goes back to, I guess, the taxonomy harmonization of the guide for market participants. So the question is, what kind of dialogue is ICMA holding with EU Commission? And are there any tax standards, GBP, GBS, etc., that we need more harmonization to guide market participants? And this is actually a question, I guess, back to Rico.
So first, to talk about the green bond standards, I think the mainstream is still the GBP, as you know. As I said, we just held the GBP AGM 2 weeks ago. 97% of the green bonds globally actually align with the GBP. So this, again, is the only mainstream standards for the green bonds. Also, again, it's voluntary. And the second, actually, we don't set very details about the definition of green. We only set very high-level categories, what are green or not. Then the EU GBS, we don't expect it will be released any sooner. First is it's a long-term project, and also at the international market level, at least from my personal view, is the market don't have a strong mandate for regulators to step in to set really hard standards. So I would expect the green bond will still follow the GBPs. Although we note that in different jurisdictions, particularly in those developing countries, they have different local standards to issue the green bond, but that's not the mainstream, and also probably won't apply for Hong Kong, which is international harbor for such financing. Then taxonomy is another thing. First is that you look at the definition of green, for example. As you know, at the international level, the EU, China always do such harmonization between the two. And I can tell you with the 2021 version of the PBOC Green Bond Catalog, more than 80% are aligned with each other. So we actually, when you talk about the more harmonized definition of the green, I think at least from the investor or international community, we are not that concerned. But obviously a misunderstanding, which I notice, is taxonomy in EU. It's a hard regulation for all the sectors, just applies to everything. But for the PBOC Green Bond Catalog, which actually is just only applies when issue green bond. So it's not universal standards for such thing. Although there's an NDRC industrial green standards, but it's, the two actually are different. So in that sense, we want to have more education for the market, what's happening really, particularly in China or EU, who are really leading in such efforts. And I think in the bond area and in the green area, they are different. But I think, again, I don't see a big gap or difference between the two, although, harmonization is always good.
Okay, great. No, thank you. That's good. I think we probably have room just for 2 more questions before we wrap up with the closing remarks. And the question goes to Chani, which says, I think you briefly mentioned that projects initiatives are incompatible with net zero goals will be precluded, discouraged, i.e. no phase out plan before 2050. How strict is this requirement and how can this be enforced?
So when we put the paper together, Navigating Climate Finance, this is as a proposal that we put up as the voice from Hong Kong, SAR, and from China perspective, in the global discussion of climate transition. So certainly, we are in no position to say this is a hard requirement from Hong Kong GFA's perspective. As you heard from Rico, right, there's no transition bond principle, but there's certainly that issuer level disclosure when it comes to transition finance handbook that was launched by ICMA. So the 5-step that we propose with the ultimate goal to phase out is certainly our perspective. And I think, to some extent, it's fairly aligned to what ICMA is proposing, right? In the long run, how do you align your overall business, to science-based decarbonization? That's where we are really coming from. So, so I think if you take into account of, what we propose, at the Hong Kong GFA paper, also in consideration of ICMA Climate Finance Handbook, this is something that, we think could make that transition credible. And credibility is very important in the fixed income market, regardless of bond or loan or whatever instrument that you're considering. So it's not a hard requirement, but certainly the best practice that we are advocating, to the market.
Great. I think we have one more question that's come from the audience, and it's probably addressed to Thomas and Cedric, given that there's talk about transitioning of the brand industries and the creation of jobs and employment. The question is, given the importance of employing experienced and knowledgeable professionals to avoid greenwashing, can any of the panelists provide an idea of the kind of education or qualifications that will be required by the finance industry? And how can those of us that are interested in this area enter the industry of green or sustainable finance?
Thank you for the question. I can start. So indeed, there are huge needs of to green jobs across industries, but also in the financial sectors. There have been some controversies about ESG washing skills. So what is possible? There are lifelong trainings opportunities for people that are already working in companies, so they can follow certifications. There are a number of programs at different schools that are proposed. Some MBAs are increasingly including ESG and social finance topics. So you can go back to school, follow short trainings, and also within companies there are formations that are available. There are also MOOC that are online. So there are a number of possibilities to self-train yourself and to be well equipped. In terms of skills, what is necessary, it really depends on the type of clients and what you want to do. You need a good mix of sustainability strong credentials. Should it be related to carbon accounting, biodiversity topics, but also social matters. So it's a mix of quantitative and qualitative skills. What will be very important in the years to come is also some modeling skills, because of all the transition pathway and the calculations, especially the alignment tools. So that's clearly something where there is high need. And last but not least, when it comes to impact reporting, because all we do needs to be evidence with tangible proof and demonstrating impact, the actual benefits of social finance, should it be use of proceeds or general corporate purpose instruments, is very critical. So we really need to progress on that impact demonstration area.
Great, thank you. And I know we have 30 seconds more. So Joseph, if you would like to just give some comments in terms of perspectives from Hong Kong and what we're doing here to really promote the industry, that'd be great. Thank you.
Yes, please. Thank you. In Hong Kong, to begin with, actually, Hong Kong University and also the University of Science and Technology also offered ESG-related courses there. So definitely on the tertiary education level, we are promoting ESG and ESG investing. And also on industry level, as we all understand, a lot of those ESG standards and trends are fairly new and still evolving. So we are working closely with the industry and different professional bodies, including the HKGFA, including the Hong Kong Quality Assurance Agency, and other local institutions to provide ESG related courses to market practitioners. In that sense, actually, some of these courses are also eligible for subsidies under the government program, what we call the pilot program for enhancing asset and wealth management talents as well. So that you can see we are providing these courses with local professional bodies. We're providing certain financial incentives for the market protection practitioners to participate into them. And also on the university level, we have these as well. We recognize the importance of talents for ESG development, and we'll continue to work closely with the industry to offer these type of education opportunities. Thank you.
That's really excellent news and very good to hear. I think we are now, unfortunately, out of time. It's a very rich webinar. I'll pass you over to Chani Huang for the closing remarks. Thank you.
Thanks, Jenny. I think you just gave me the hardest job to sum up from so much content and insight from our VIPs, our speakers. So, I mean, I think the webinar really jumps into a very fast-growing global discussion of climate transition finance with insights and views from China, Hong Kong, SAR, as well as from Europe, which are the two biggest markets when it comes to sustainable finance, right, in terms of volume. And I think there still could be differences, in terms of views to define transition finance, depending who you are, where you're coming from. But I think transparency is probably the best policy here, providing the local contextualization, current constraints, ambitious viable options, short-term and long-term, and also concrete roadmaps towards the long-term net zero goals that are aligned with local, regional, and Paris ambitions. So I think my last word would be a lot of thanks, to Hong Kong GFA members, friends, and Under Secretary Joseph Chan, others and speakers, and co-chair of the Hong Kong Green Finance Association Green Bond and Innovation Working Group, and the Secretariat for making this webinar very possible. So please stay in touch with Hong Kong GFA, and please stay safe as well. Thank you very much for everyone. Thank you.